Welcome to the deep dive. The pension issue we're addressing this morning is the commutation inequity among regional rural bank pensioners. I am Priyanka Chakraborty and my co-host is Nisha Bhattacharya.
Okay, let's imagine a scenario for a moment. You've worked your whole life, decades of service, and you're promised this substantial financial benefit, a lump sum.
But because of government paperwork, bureaucratic delays, it takes a few extra years to actually process.
The usual red tape.
And because of that delay, you get significantly less money. I mean, we're talking hundreds of thousands of rupees less than your colleagues who retired just a little bit later.
No way.
And here's the kicker. When it's time to pay back the portion you took out, you have to repay the full original amount, the same as the person who got the bigger check.
And that right there is the core paradox we are diving into today.
It's just fundamentally unfair.
It is. Our mission today is to really get into a very specific, very technical flaw in how a new pension scheme was implemented. We're talking about long retired employees of regional rural banks or RRBs.
And this isn't just like a simple accounting error, right?
No, it's a systemic calculation flaw. It all centers on this concept of commutation value, and it ended up creating two totally separate classes of pensioners.
We're going to drill down on the difference between calculating a benefit on the date of retirement versus the date of commutation.
And why that difference is just financially devastating for the people who, ironically, worked the longest.
Okay, so let's unpack this. We have to start with the regulatory context, the timeline.
Right.
This issue, you said, applies specifically to retirees of the regional rural banks. So, what was this new scheme supposed to do? And when was it supposed to start?
Well, the intention behind it was good. It was meant to implement a new unified pension payment scheme. And formally, this scheme was introduced and deemed effective as of April 1st, 2018. That's the critical starting point for the benefits, yes.
But as anyone who's ever dealt with a large government rollout knows, the effective date is often very different from the actual implementation date.
Precisely. That delay is the root cause of the problem we're talking about.
Okay,
So while April 2018 was the effective date on paper, the scheme had to go through this really slow, strict bureaucratic process.
all the red tape.
We're talking gazette publication, public notification to thousands of retirees. They had to submit formal applications. And crucially, they had to refund the employer's share of the Provident Fund if they opted into.
That just sounds like a huge administrative nightmare. How long did it actually take for people to get access to the scheme?
March 2019, it was at this point that retirees could finally apply and the banks could process everything.
So you've got a gap of about a year, maybe more, between effective date and implementation day.
A year where the benefit was legally effective, but you just couldn't access it.
And this is crucial. The people applying in 2019 and after, a lot of them were people who had retired years before 2010, right? They were just waiting for this to finally happen.
And that's the group that gets hit. Once the functional green light was given, it's completely logical that many of these long retired employees would opt for commutation.
And commutation is basically taking a lump sum upfront.
Exactly. It's essential for retirees. Lets them take a big chunk of cash, in this case, 1/3 of their basic pension to pay off a mortgage, cover medical bills, whatever they need.
So the stage is set. Thousands of senior long retired employees finally apply for their lump sum after March 2019. And that brings us to the critical calculation error that split this group in two.
Yeah, so to explain the error, we need to be really clear on what commutation is in this context. It's a calculation basically. The bank pays you a lump sum that's equivalent to, say, 10 or 15 years worth of part of your monthly pension.
And in return,
You accept a smaller monthly pension for a fixed period, usually 15 years, until that lump sum is considered fully repaid.
it's like an advance on your future pension based on some kind of factor. That number is what determines how big of a lump sum you get.
And that's where the RRBs went wrong.
How so?
The central conflict is the date they chose to factor from.
Okay.
So, when the RRBs were processing all these applications after 2019, they calculated the lump sum value based on the pensioner's age as of the date of commutation, the day they finally applied.
Okay.
They completely ignored the value of commutation as of the date of retirement, which for many retirees was several years earlier.
Hold on. Why is the date of retirement factor better for the retiree? That sounds counterintuitive.
It's because the factor is actuarial. It's based on mortality tables.
Okay.
The lump sum you get is calculated using an age factor that determines your expected remaining lifespan at the time of the calculation.
Okay, let's drill down on that. Why does being older when they do the calculation automatically mean a smaller payout?
Because the older a person is, the lower their statistical life expectancy is. The commutation is a benefit that represents a slice of your pension over future years. So the actuary tables assign a lower multiplier factor to an older person because of a shorter life expectancy.
Less expected time alive means a lower lump sum payout.
That's the math, yes.
And that's where the delay becomes so incredibly damaging.
Exactly. So if you retired in 2015 at, say, age 58, your commutation factor should have been based on the life expectancy of a 58-year-old.
Right.
But if you couldn't even apply until 2019, 4 years later, the bank calculated your lump sum based on the factor for a 62-year-old.
And that's a lower number.
Much lower. The value of commutation calculated on that later date is mathematically and significantly lower than the value they were entitled to on their actual date of retirement in 2015. Time worked against them simply because the paperwork took too long.
So this one decision created two very different groups.
Yes, let's define them clearly. Group 1, we can call them the post-scheme retirees. These are the people who retired after the scheme was fully up and running, say in 2020.
So their retirement date and their commutation date are very close together.
Very close, which means their age factor was correct and high. They got the proper higher lump sum they were owed.
And then in group 2, the victims.
The pre-scheme retirees. They might have retired in 2015, were forced to wait until 2019 to apply, and so they had their lump sum calculated using that lower age deflated factor.
And just to be clear, this wasn't their choice.
Absolutely not. They were taking the benefit at the earliest moment the bank allowed them to. The delay was purely administrative.
Okay, this is where the story gets really interesting and frankly unjust. The fact that the lump sums were different is bad enough. But the core paradox is this. Even though Group 2 got a smaller lump sum, their repayment obligation is identical to Group 1.
This is the shocking part that our source really hammers home.
How can that be?
The repayment of the commuted portion is fixed. It's based on repaying 1/3 of your basic pension over a 15-year period. Since both retirees had the same basic pension, the total amount they are paying back is exactly the same,
Regardless of what they received upfront.
regardless of the initial lump sum.
So they are paying back the money they were owed, not the money they actually received. That just sounds like a contract gone completely sideways.
It is. The contract effectively forces them to pay back the full theoretical benefit, even if the bank's own delay meant they only got a fraction of it.
We must look at the numbers to really get the gravity of this. The source give a great example. Let's take a retiree with a basic pension of 30,000 rupees.
Okay, so their commuted portion would be 1/3 of that, so 10,000 rupees per month.
Right, let's start with case 1. The post-scheme retiree, let's say they retired on May 31st, 2020.
So their age factor was high, it was correct. The formula used a factor of 10.13.
So their lump sum is 10,000 rupees times that factor of 10.30 times 12 months. That comes out to
12,15,600. Okay, and their total repayment over 15 years.
That's the fixed part. It's 10,000 rupees a month times 12 months times 15 years. The fixed repayment obligation is 18 lakh rupees.
18 lakh. Okay, so that's the benchmark.
Now let's go to case 2. Our pre-scheme retiree retired much earlier. Say May 31st, 2015. Same 30,000 basic pension, same 10,000 commuted portion, same 18 lakh repayment.
However, the calculation uses that later lower age factor of 8.1 fund instead of 10.13 because they're older when they applied.
An actuarial factor of 8.1 INP instead of 10.13, that single change completely alters the math. What was their lump sum? 10,000 rupees times 8.15 times 12. The total amount they received was only 9,08,000 rupees.
They were shortchanged by hundreds of thousands of rupees just because the scheme took too long to implement.
So let's just put those side by side to really drive this home. Both individuals have to repay the full 18 lakh rupees.
But the first retiree got 12,15,600.
And the second, more senior retiree got only 9,78,000.
The difference, the quantifiable loss, is 2,37,600 rupees.
That money was supposed to be theirs. It was factored into the total amount they are now repaying, but it was never ever disbursed to them. That's a huge amount of money for a retiree. That's capital, that's security, that's gone.
And if we look at the implications, this isn't a static loss either. It actually gets worse the earlier you retired. That's right. Our source highlights that the loss is progressively increasing. The more senior the retiree, the bigger the age gap between their retirement date and their commutation date, and the bigger the financial hit.
So the people who served the longest got penalized the most.
It's completely backwards.
So this raises a really important question about fault. In any legal or financial system, who is to blame here? Can the banks argue the retirees should have known there would be delays?
And the source material is completely unequivocal on this. There is, quote, no fault of the pensioner.
Right.
This isn't negligence on their part, it's a direct result of a flawed implementation. The loss was created solely by the choice to use the application date instead of the legally relevant retirement date. They couldn't apply any earlier.
You know, the source provides an analogy that I think really makes the injustice here crystal clear.
It's the best way to understand it. Source equates this whole situation to a bank.
Go on.
To a bank recovering an amount fully without disbursing the full sanctioned loan amount.
So it's like you take out a mortgage for, say, 15 lakh rupees. The bank only ever puts 12 lakh in your account.
Exactly.
But then they demand that you make payments with interest on the full 15 lakh.
You'd be furious, you'd be in court.
Of course. And in this case, the RRBs are acting as that bank. They're demanding full repayment on the 18 lakh value, even though their own mistake meant they didn't hand over the full amount to the earliest retirees.
The individual retiree is just forced to absorb that difference.
So what does this all mean for a path forward? I mean, if the analysis is this stark and the fault is so clearly on the institutional side, what's the solution?
The only fair remedy is financial restitution. The sources are very clear on this. The RRBs have to be mandated to pay the difference commutation amount with interest to all the affected pre-scheme retirees.
So using our example, that's the 237,600 rupees.
That's the principle, yes. They have to bridge that gap and make sure the Class 2 retirees get the exact same amount they would have if the calculation had been done correctly in the first place.
And you mentioned with interest, that part is vital.
It's critical. Because that money should have been in the retiree's bank account 4 or 5 years ago. It could have been earning returns or used for, necessary expenses.
Without the interest, it's an incomplete solution.
It's about recognizing the time value of money that was denied to them because of a bureaucratic delay.
We've seen how a fixed repayment, when you pair it with a variable age-sensitive lump sum, became an instrument of financial injustice.
And the takeaway for you, the listener, is that in these complex financial systems, especially with pensions and long timelines, bureaucratic delays can inflict this kind of disproportionate harm.
The people who served the longest were made to pay the cost of RRB's implementation failure.
Which I think leads us to our final thought.
If the commutation value, a major predictable payment, was miscalculated for thousands of people because of this timing issue, with losses in the hundreds of thousands of rupees, it raises a pretty significant and maybe provocative question.
Which is,
are there other benefits or smaller allowances or other entitlements within this and other pension schemes that also rely on time-sensitive factors? And could they also be silently miscalculating against the most senior earliest retirees?
That's a question that demands a deep dive into every corner of the regulatory fine print.
It really does.
Thanks for joining us. Please subscribe, share, and like. Until next time.